wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the financial markets. And this is with a view to helping you better understand how the markets operate so that you can make informed investment decisions. And we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 201, and in this episode we are reviewing the performance of the financial markets during the 8th week of 2026, and that is from Monday the 23rd to Friday the 27th of February. And without further ado, this is your host Jamuhuri, and together let's dive right in. We kick it off in the Middle East, where on Saturday the US and Israel began what President Trump dubbed as Operation Epic Fury, striking military and nuclear targets in Iran, and as Iran retaliated with strikes across the Middle East. Trump said his objective for the attack was to defend the American people by eliminating imminent threats from the Iranian regime. The president announced the strikes in an 8-minute clip posted to his Truth Social account on Saturday. This move could cause a broader conflict in the region, as Iran has vowed a crushing response to this attack. And back in the United States, according to a report from the Bureau of Labor Statistics that was released on Friday, wholesale prices rose at a faster than expected pace in January, countering hopes that inflation was easing off. The Core Producer Price Index, which excludes volatile food and energy prices, this increased by a seasonally adjusted 0.8% in January, compared to a gain of 0.6% in December, and was well ahead of the Dow Jones consensus estimate of 0.3%. Producer prices automatically feed into consumer prices, and therefore we can expect a pickup in consumer price inflation in the near term. For the full year 2025, the Core Producer Price Index accelerated by 3.6%, and this figure remains well above the Federal Reserve's target rate of 2% and suggests that inflation remains a factor for the U.S. economy. And over to China, where on Tuesday, China's central bank kept its benchmark lending rate on hold as it seeks to balance between supporting a slowing economy and maintaining currency stability. The People's Bank of China held its 1-year and 5-year loan prime rates at 3% and 3.5% respectively, keeping them on hold for a 10th consecutive month despite stuttering economic growth. The one-year rate serves as the benchmark for most new and outstanding loans, whilst the 5-year rate influences the cost of mortgages. The world's second-largest economy showed signs of slowing down in the final quarter of 2025 as it expanded by 4.5% year-on-year, which was the slowest pace of growth since late 2022. According to LSEG data, the Chinese yuan has continued to appreciate in recent months, with the offshore yuan strengthening to around 6.889 per US dollar on Tuesday morning. China's central bank manages the yuan by keeping it within a band of 2% on either side of the midpoint rate, which it fixes every trading day. And for the first time in nearly 3 years, the central bank has allowed the midpoint rate for the yuan to drop below the key benchmark of 7 yuan to the US dollar. On Wall Street this past week, stocks dropped on Friday after the latest producer price index came in much hotter than expected, adding sticky inflation to a list of concerns that have caused market turbulence in the month of February. The S&P 500 and the Nasdaq Composite closed the month of February in the red amid growing concerns about the impact of artificial intelligence on specific industries and the overall economy. Those concerns were exacerbated after Jack Dorsey's fintech company Block said it was laying off more than 4,000 employees, which is nearly half of its workforce. In addition to that, stocks linked to the private credit sector also came under pressure as investors anticipated a broader sell-off following the collapse of a UK mortgage provider by the name of Market Financial Solutions. In response, the Dow Jones Industrial Average dropped by 521 points to close at 48,977, whilst the S&P 500 dipped by 0.43% to end the day at 6,878, and the tech-heavy Nasdaq Composite lost 0.92% to settle at 22,668. And a word of caution from a reliable source. During an annual investor update on Monday, Jamie Dimon, the CEO of JP Morgan Chase, said that he was anxious over the U.S. economy, citing elevated asset prices and a competitive environment in the banking sector that reminded him of the situation prior to the global financial crisis of 2008. Even as economists publicize the positive impact of Trump's tax and deregulation policies, Dimon said that his own tendency was to consider what could go wrong when expectations are riding high. Dimon said that the economic cycle will inevitably turn around, leading to a wave of borrower defaults that could broadly affect lenders and also impact producers and ultimately consumers. In the government bond market, U.S. Treasury yields fell on Friday as investors reacted to a stronger than expected wholesale inflation report for January and a stumbling stock market driven by concerns that artificial intelligence could negatively impact economic growth. Bond yields fell below the psychological 4% level, and this was on the back of rising fears that artificial intelligence could lead to massive job losses and eventually contribute to a slowdown in economic growth. The potential for AI disruption has increasingly weighed on the markets this year, with software stocks getting slammed on concerns that agentic AI will make legacy companies obsolete. In response, the yield on the short-dated 2-year Treasury note was lower by more than 5 basis points at 3.389%, whilst the yield on the benchmark 10-year Treasury bond fell more than 5 basis points to settle at 3.962%. For your information, 1 basis point is equal to 0.01%, and bond yields and prices move in opposite directions, which means that as interest rates rise, bond prices fall, and vice versa. In the commodity markets, the price of crude oil rose by more than 2% on Friday as traders remained alert to the potential of supply disruptions, and this was after the United States and Iran extended their ongoing nuclear talks. Oil prices gained more than $1 a barrel during the talks as media reports indicated that discussions had stalled over U.S. insistence on zero enrichment of uranium by Iran. However, the ongoing talks have been overtaken by recent events as the US and Israel have launched a full-scale war against Iran. The commodity markets are currently pricing in a geopolitical risk premium of about $8 per barrel, driven by concerns of a wider conflict in the Middle East that could disrupt oil supply through the Strait of Hormuz, where 20% of global oil supply passes through. The price of the global benchmark Brent crude advanced by $1.73 to close at $72.48 a barrel, whilst the U.S. benchmark West Texas Intermediate crude increased by $1.81 to settle at $67.02 per barrel. In the precious metals market, gold rose to near a 1-month high on Friday and was headed for a 7th straight month of gains, supported by geopolitical tensions after the United States and Iran extended nuclear talks, while softer U.S. Treasury yields further boosted the demand for bullion. Negotiations between the U.S. and Iran ended without a breakthrough on Thursday, increasing the probability of a U.S. strike against Tehran this weekend. This was further confirmed after the U.S. Embassy in Jerusalem permitted non-emergency staff and families to leave Israel, citing safety risks. And as we are all aware, this has also been overtaken by events as the US and Israel have launched a full-scale war against Iran. The latest data showed that US producer prices increased more than expected in January, suggesting that inflation could pick up in the months ahead. As per the CME Fed Watch tool, markets are now pricing in about a 42% chance for a 25 basis point rate cut by the U.S. Federal Reserve in June. The yield on the 10-year U.S. Treasury slipped to a 3-month low, reducing the opportunity cost of investing in a non-yielding asset like gold. In addition to that, an increase in geopolitical tensions has switched market sentiment to risk off, causing investors to flock to the safety of bullion. The price of spot gold has risen by 7.6% in the month of February and was last seen trading at $5,230 per ounce. We now change scene to the Kenyan financial markets, and we start by looking at the cost of living in the country, where headline inflation remained relatively stable at 4.3% in the month of February compared to 4.4% in January 2026. Meanwhile, core inflation, which excludes volatile food and energy prices, this declined from 2.2% in January down to 2.1% in February, and this was mainly on account of reduced inflation for processed food items. Similarly, non-core inflation, which focuses on food and energy prices, this eased off from 10.3% down to 10.1% in February, largely driven by lower energy inflation. In the domestic foreign exchange market, the Kenya shilling remained static versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at the same rate for the past 3 weeks, and that was at 129.02. Meanwhile, the sterling pound was priced at 174.34, and the euro was valued at 151.94. And on the regional front, one Kenya shilling was changing hands for 27.84 Ugandan shillings and 19.84 Tanzanian shillings. And to the Rwandese franc, it was posted at 11.29. The IMF has previously raised concerns about the extreme stability of the Kenya shilling, but the central bank insists that it continues to operate a floating exchange rate policy. However, the data tells a different story, as the dollar-shilling rate has been stuck at between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 60% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves declined by $124 million for a grand total of $12.53 billion, which is equivalent to 5.4 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this relatively massive position, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. In the money markets, during the past week, the interbank market was sufficiently liquid and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenya shilling overnight interbank average, aka Kesonia, this is the rate that banks use to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate was stable at 8.77%, which is in sync with the revised central bank rate at 8.75%. 3.75%. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio that is currently set at 3.25%, this averaged at around 52.3 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 26th of February, and the central bank received bids totaling to 58.5 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of 243%. The central bank ended up accepting about 41.8 billion shillings, and the results of the auction were as follows. The 91-day rate was stable at 7.58%, whilst the 182-day rate rose by 5 basis points to average out at 7.80%, and the 364-day rate declined by 11 basis points for a weighted average rate of 8.78%. In the primary bond market, the Central Bank of Kenya has published its prospectus for the March Treasury bond issuance, in which it is looking to raise a total of 60 billion shillings through the sale of 2 reopened Treasury bonds whose terms and conditions are as follows. The first bond is a 20-year bond that was initially issued in 2019 and now has 13.1 years left to maturity. This bond has a coupon rate of 12.87%. And the second bond is a 25-year bond that was initially issued in 2021 and now has 20.1 years left to maturity. This bond has a coupon rate of 13.92%. Please note that both bonds are now open for sale until Wednesday, the 11th of March, when the auction will be held. And in the secondary bond market, the Central Bank of Kenya is offering investors the opportunity to switch their investments from a bond maturing in November 2026 and to reinvest in another bond that matures in July 2034. Participation in this switch auction is on a voluntary basis, and investors may opt to switch either part or the entire holding in this bond. This offer is capped at 15 billion shillings and is available to the current holders in the source bond, which is FXD1/2021/005, which has a coupon rate of 11.27% and which matures in November 2026. And the offer is to switch their investment to the destination bond, which is FXD3/2019/015, which has a coupon rate of 12.34% and which is set to mature in July 2034. At the Nairobi Securities Exchange, cigarette manufacturer BAT Kenya has announced a final dividend of 60 shillings per share after its net profit rose by 17% to 5.25 billion shillings in the year ended December 2025, which was driven mainly by lower operating costs. The final dividend, when added to the earlier interim dividend of 10 shillings per share, brings the company's full distribution for the year to 70 shillings per share, amounting to a total payout of 7 billion shillings, which exceeds the company's net profit for the year. The full year payout represents a 40% increase from the 50 shillings per share that was paid out in 2024. This final dividend will be paid on the 12th of June and will be paid to shareholders on the company's register as at the close of business on the 8th of May 2026. Up next is our topical issue, and this week we're looking at two issues. The first is concerns that domestic borrowing will crowd out lending to the private sector. The National Assembly Committee on Public Debt and Privatization has warned that government's increased borrowing from the domestic market could slow down economic growth by crowding out businesses and households from the credit market. The warning comes as lower interest rates have opened a window for the National Treasury to ramp up the auction of Treasury bills and bonds through the Central Bank of Kenya. The committee has asked for the appropriate sizing of domestic borrowing limits as the Exchequer outlines its reliance on domestic funding to plug the budget deficit in the medium term. Net domestic financing for the upcoming fiscal year 2026-2027 is expected to remain elevated at 890 billion shillings as Kenya's domestic debt stood at 6.83 trillion shillings, and that is as at the end of 2025, representing 55.6% of the total debt stock of 12.29 trillion shillings. And the second issue is a study by the IMF that favors mobile money and power data for Kenya's GDP forecast. A team of researchers at the International Monetary Fund has said that monthly data on mobile money transactions, electricity, and vehicle production reflects Kenya's economic output more accurately than the quarterly GDP data. The researchers observed that tracking Kenya's near-term economic activity is presently problematic, partly due to the delay in GDP growth releases, which are typically published with intervals of at least 1 quarter. Kenya has been publishing quarterly GDP since 2009, and even though its macroeconomic data is relatively high quality, the reporting delay typically exceeds 3 months after the end of the quarter. This delay complicates the design and timely implementation of macroeconomic policies. The researchers said that their test forecast based on data releases on digital money, vehicle production, electricity plus imports and exports presented better results on Kenya's GDP performance. The researchers noted that their model offers a practical way to continuously update near-term GDP growth predictions as new macroeconomic data becomes available. Mobile money data has been deemed a timely indicator of Kenya's economic performance, with data published within 3 weeks of each month for the preceding monthly cycle. Digital payment systems led by platforms like M-Pesa have revolutionized financial access in Kenya, with over 85% of the population now utilizing digital financial services. Mobile money facilitates over 53% of Kenya's GDP through agents enabling daily transactions, savings, and credit for previously underserved populations. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share this podcast with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamhurigi@gmail.com. Jamhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, great works are performed not by strength, but by perseverance. A quote by Samuel Johnson. Think about it. Thank you, and God bless.